Hey guys, Clinton Sistrunk, Colorado Mortgage Team. All right, today I want to share my 3 top ways to avoid capital gains taxes when you sell an investment property. Yes, it can be done. Now, let's jump right in. So the obvious one that everybody has heard about and is really popular is the 1031 tax exchange. All right, now the tax exchange is a really good method if you've got another property lined up or that you want to roll those funds from that investment property into another investment property. And you can get creative with it. It doesn't have to be like single family to single family. You can go single family to commercial, single family to condo. You can go single family to 2 condos to 3 single families. You can split the money up, buy multiple properties. You can even get into things like DST funds and REIT funds and things like that that are made as vehicles to invest in real estate. So there's a lot of flexibility there on the 1031 side, but you got to go into real estate. So what's another way? And we'll do another video. We'll dive into some details about 1031s and how to do that successfully. But let's move on to the next one. So the next one that I really like is doing a self-directed IRA. So let's say you have a Roth IRA right now, and it's either a 401k or maybe it's that you haven't rolled over and you roll it over. You can get a self-directed IRA. Now, what do you do with a self-directed IRA? You can invest in almost anything you can think of. So think businesses, real estate, tax liens, gold, just all sorts of things. But when it comes specifically to real estate, you can go in and buy it within your IRA. Now, there's some rules here. You can't be involved. It's got to be 100% owned by the IRA. You can't take possession of the property at any time. You can't go over and put sweat equity into it. You need to hire a property manager. Like, it's all got to be third party. But you can even get financing within your IRA with non-recourse loans. Now, they have a little bit higher down payment requirement because of the fact that it's non-recourse, but you can finance property in there. And then when you go and sell it, you get the same tax benefits as you would as any other gains that you have in that Roth IRA. And you don't have to immediately go buy real estate with it. You can put it in your IRA and go invest in something else if you want to. It's a great tool and with a lot of flexibility that allows you to avoid capital gains. Now, third, and I don't know, this might be one of my favorite, I just used it earlier this year, is if you take a property that's an investment property and you put it into a trust, you get step-up basis. What that means is, let's say you bought a house for $400. Now it's worth $600. And when you go to sell it, you're faced with that $200,000 gain. Now, obviously, there's a lot more that goes into that calculation, but let's just keep it simple. And you don't want to pay capital gains on that $200. Well, right when you go under contract with that property, you could immediately put it into a trust. It steps your basis up so that you no longer have any capital gains, and you sell it in that trust. Now, there's a lot of things you can do once you have that trust funded with that real estate, and it doesn't mean that you have to put the money right back into real estate if you don't want to. So just another sneaky way that you can avoid capital gains. And this is a trick with the trust that the rich use and the financial elite use all the time that they don't really share with the average person. Anyway, those are my 3 favorite ways to avoid capital gains on your investment properties. If you want more tips and tricks, hit me up, join my mailing list, join my email list, and definitely subscribe to our YouTube page. All right, hope you're having a great day, and we'll talk to you soon.